Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vera. Our guest today is Rick Rule, President and CEO of Sprott USA Holdings. He is also the founder of Sprott Global Resource Investments. Having survived 4 mining downturns and thrived in 4 mining upturns, Rick Rule is one of the best known and most influential people in the resource mining business. And we are delighted to have him here today as our guest. Good day, Rick, and welcome to SBTV. How are you doing?
I'm fine. Thank you for having me on. I enjoy the opportunity to talk to your audience.
Thanks for being here, Rick. Really do appreciate it. You began your career in the securities business back in 1974, and you've been involved in the natural resource security investment sector ever since. I think what that tells me or anyone else that comes across your name is that you've seen your fair share of both bull and bear markets, and you're definitely a treasure trove of wisdom, my friend.
Well, kind of you to say. I'm not sure if it's wisdom or experience, but anyway, I've been around a long time.
With that 40 years of watching booms and busts, what has it taught you about investing?
Well, certainly the first thing it's taught me about investing in natural resources generally, but precious metals too, is that ours is probably the most deeply cyclical sector in the investment landscape. The practical import of that to investors is that they either become contrarian or they will become victims. You need to invest in the sector when it seems like it is at its worst. And when the sector returns to favor, you need to begin to fashion your exit. The truth is that the basic thing that people need to know about cyclical sectors like natural resources is that bear markets, like the ones that we've been through, are the very authors of bull markets. And by contrast, bull markets, when you feel good, are the authors of bear markets. Ergo, when you're scared, you need to invest. And when you're happy, you need to sell.
That's an interesting way to put it. But you've mentioned in other interviews about having your net worth go below zero in the bear market of the 80s, and you said losing all my money was the best thing that ever happened to me. Can you share with us what happened to you and how did this experience change the way you viewed markets?
Sure, though I laugh painful to this day. I grew up in the investing business, if you will, in the 1970s, an era of unprecedented success in natural resources. Many of your viewers aren't old enough to remember those days, but the whole narrative in investing was natural resources. And as a consequence of me being in a sector that was in an unprecedented boom, I made the typical young man's mistake of confusing a bull market with brains. I also made the mistake of allowing the price action in the sector, oil going from $2 to $30, as an example, to change my narrative. I began to believe, like the big thinkers of the time, that markets didn't work and that the result of high prices would be more production and less consumption and a price crash. When that price crash occurred, I was unprepared for it in 2 ways. The first is that I was psychologically unprepared because I had excessive faith in my own abilities relative to the state of those abilities at the time. And of course, also, I believed that a trend in motion was going to continue irrespective of markets. I learned the cyclicality in the markets in a very painful way. And when I say it was the best thing that could possibly have happened to me, perhaps what I mean is it's the best thing that can happen to people who are clients of ours currently, because I have a deep reservoir of scar tissue that will probably keep me from repeating that kind of mistake in as egregious a fashion ever again.
Okay. I think one thing with these bear markets, we do tend to look back at a low in the price chart and we tell ourselves that we should have bought it back then. But bear markets, they're usually not the most encouraging times to buy for most investors. But could you share with us the common things that you've seen across the bear markets in the past, such as sentiment, enthusiasm, or the lack of it?
Sure. Beginning with the preface that you're never going to time the bottom of a bear market,
Absolutely
absolutely.
not.
Bernard Baruch was famous for saying that the only one who ever bought at the bottom and sold at the top was a liar, that it didn't happen.
Okay.
And bear markets go on for longer than a rational person believes that they could, just like bull markets do. In terms of the important things to remember to condition yourself psychologically for a bear market, it's most important that you understand that almost everyone's expectation of the future is set by their experience in the immediate past. And if your experience in the immediate past is painful, that is, if you've been investing intelligently in the sector but still getting spanked because you're in a bear market, the consequence of the recent experience and the consequence of the price justifying the narrative means that you will be cautious specifically when you ought to be aggressive. And conversely, when the market returns to favor, the price action that you see will justify the bullish narrative. And you will be unnecessarily aggressive when you ought to begin to be cautious. This is reflected too in the equities, in the valuation discussions that take place. Remember that asset values and resources are sort of ephemeral. They depend on the price received for the commodity. So ironically, during periods with high commodity prices, the price earnings ratios, or EBIT to enterprise value ratios, of natural resource companies make them seem cheap. When companies are enjoying 50 or 60% operating margins, they're traditionally selling at low PE multiples and low price EBIT multiples. But the commodity prices that they're enjoying are unsustainable. Conversely, at bear market bottoms, when the aggregate price for a commodity is below its cost of production, even the best producers are selling at high PE multiples as a consequence of the fact that the commodity selling price is unsustainably low. The message here is that you really have to understand the nature of the business when doing valuation discussions. You need to understand the cyclicality of commodity prices and the industry pricing structure before you decide whether a business is fundamentally cheap or expensive.
One of the things like we've noticed, bear markets, during bear markets, some investors they throw in the towel, and but the fundamentals they're the same at that time as they were when they first got in. Maybe the price just did not move according to their time frame. But would you agree that having patience while keeping your eye on the ball is one of the biggest virtues that you could have as an investor?
Absolutely. Combining that with knowledge, discipline, and conviction, understanding where you are in the cycle and understanding the rationale for owning an investment. In your particular case, in the bullion space, I would say that people either believe in bullion investments or they don't. I think it's as simple as that. If you believe in bullion investments, what a bear market really is a sale. It's an asset class that you want to own or you don't want to own. It's difficult for me to understand why people wouldn't, but that's a separate discussion. If you believe in the asset class, then bear markets are an absolute gift to you. Despite the fact that I'm 65 years of age, as an example, I still consider myself to be in the wealth creation phase. That is, that I still want to keep accumulating wealth. The fact that I personally regard precious metals as an interesting store of wealth, and also as, if you will, catastrophe insurance, the fact that I have been able to acquire additional stores of precious metals for my own portfolio is something that I personally consider to be a blessing.
We hear that also where there are some people who will say there's a time to make money, then there's a time to protect what you've made. So we kind of see both sides of it as well. But you've mentioned in past presentations about the ascent of man and the need for natural resources. Can you elaborate a bit on that?
Well, thank you. You spent some time studying my work, which I appreciate.
Yeah, every now and then I do have to let the boss know I do some work.
You're commended for it. This is an important theme that you describe. I've been traveling to emerging and frontier markets for 40 years as a consequence of my work and resources, because deposits are often located in those places. And one of the heartening things that I've seen while doing that is the incredible progress that the bottom quarter of the global society has made, the material advancement of extraordinarily poor people around the world. That isn't to say that they aren't still extraordinarily poor, but relative to where they were when I started traveling, the advancement of the ultra poor on a global basis has been extraordinary. And this is probably the most important trend in natural resource investing. The bottom quartile by income of people worldwide aspires to live the way that you live and the way that I live. You and I live an extremely resource intensive life. When you or I get more income, the things that bring us utility are seldom stuff. They're services or technology or things that are not commodity intensive. But when very poor people get more money, the things that bring their life more utility are extremely commodity intensive. They may increase their per capita calorie consumption from 1,500 a day to 22 or 2,400 calories a day. They may change their mode of transportation from walking to a bicycle, to a 50cc motorcycle, to a Toyota Hilux. They may swap out the building materials for their house from mud and stick to cinder block, from a thatch roof to a metal roof. The point is that when the poorer people, the bottom 2 billion of the demographic pyramid, acquire more wealth, which they are doing rapidly, the wealth that they acquire is spent on increasing their material standard of living. And that's increasingly very important to commodities. Urbanization is a second trend. In emerging and frontier markets around the world, you're seeing a dramatic shift from rural subsistence agriculture to urban environments. And in urban environments worldwide, the median annual income is twice the median annual income that it is in rural areas. And again, the money that is acquired, the wealth that is acquired, is spent disproportionately on commodity-centric material goods.
Okay, yeah, I understand what you're saying. I think you had mentioned about how in Malawi, I believe, where there was malnutrition and then there was obesity. They had an obesity issue. So that I think
I'm not
that's
sure. I love to point that out. I'm not sure that that's great evidence of the ascent of man, but it certainly talks about how very, very, very poor people spend their money.
yeah, I can see that you're absolutely right. But I'd like to get your views on gold before we go into other resources that you're currently looking at. Is gold still in a bear market right now, or are we in an early bull market?
I think that depends on where you live. If you spend almost any other currency in the world other than the US dollar, gold is clearly in a bull market. We're in an odd period where the US dollar has done extremely well and gold has done okay too, even in dollar terms. But what that means is that if you spend almost any currency in the world other than the US dollar, gold has done an extremely good job preserving your purchasing power. Moving on to the world I inhabit as an American spending US dollars, I think the circumstance is a little different. And I'll describe that a bit. My own experience is that really since the 1970s, the most important determinant of the gold price has been global faith in the continued purchasing power of savings denominated in US dollars. And I think the benchmark instrument for expressing that faith has been the US 10-year Treasury, which is arguably the world's benchmark security. The US 10-year Treasury has been in a bull market. That is, that faith in the purchasing power of the US dollar has been in a bull market since 1981. The 10-year interest rate peaked at 15.6, which is to say the bond was at its lowest price relative to the interest that it yielded in late 1981, early 1982. The bond yield fell, that is, the principal value rose for 35 years, bottoming or peaking, depending on your point of view, at an interest rate of about 1.78. It has currently gone up to about 3%. Now, there are a couple conclusions that you can take from this, but the first is certainly that after a 35-year bull market in the US Treasury, it is almost certain that that bull market is either over or at least closer to the end than to the beginning. If you believe that to be the case, it's a simple extrapolation to say that a bull market in gold, which trades inversely to faith in the US dollar, is closer to the beginning than to the end. Now, here's the arithmetic to go with the narrative. The US 10-year Treasury is a semi-secured obligation of the United States government secured by the US economy. The Federal Reserve in the United States released a study in June of this year that showed that the net household assets in the United States exceeded $100 trillion for the first time in history. That's fairly encouraging, except that the Congressional Budget Office estimates that the net present value of total government obligations throughout the United States, federal, state, and local, and on-balance sheet obligations and the net present value of off-balance sheet obligations, like Social Security in my case, exceeded $200 trillion. So if you think about the status of what we owe relative to how we have the ability to service it, and if you look at the fact that the US 10-year Treasury expresses creditors' faith in the US economy, my suspicion is that the next 5 years could be very good for gold, irrespective of its current strength.
Okay, yeah, we've had quite a few guests on the show. They've brought up the point where the 10-year bond it may invert with the 2-year, and if that should happen, we'd be looking at a recession, and that would be excellent for gold.
That's above my pay grade. I can only say that I am concerned with my country's balance sheet and income statement. And my concerns about our balance sheet and income statement, in conjunction with the fact that we've been in a 30-year bull market with regards to the US dollar narrative, tells me that narrative, that bull market, is closer to its end than to its beginning.
With gold, are we at the point where, as you've said before, the cure for low prices is low prices? So do you see value already in the current gold price to buy, or should prices be even lower?
I don't have an answer to that in the near term. I personally believe, in my own case, that gold fulfills a couple of functions for me. I see it classically as a medium of exchange that is simultaneously a store of value. And I don't see that in fiat currencies. I also see it having fulfilled a role for literally centuries as a form of insurance, as a way of protecting yourself against the depredations of the collective. I shouldn't have to own any gold personally because I'm a very large shareholder in Sprott, Inc. And to the extent that the gold price did well, my business and the shares of my business that I own should be expected to do extraordinarily well. That notwithstanding, I do own gold. I own it the way that I own life insurance, auto insurance, and house insurance. I own it because it helps me sleep nights and stay calm. A circumstance where the gold price did extraordinarily well would probably impact negatively other aspects of my life. So I'm in the odd position of owning a lot of gold and hoping that it doesn't go up dramatically in price. But I sleep better owning gold. And one of the consequences of being a now aging human being with a lot of wealth relative to my needs is that sleeping nights is, to me, an affordable luxury at the current gold price.
Yeah, I hear you. One of your quotes from the past interviews, you mentioned when your outgo exceeds your income, your upkeep becomes your downfall. And as you mentioned, we do live in an era where high levels of debt and inflation, it's pretty rampant right now. But given that gold is mostly a monetary metal, do you think its current price relative to the last 40 years is a result of monetary inflation?
I don't. I think that its current price relative to monetary inflation is stupidly low. I think that the gold price reflects a public confidence in the collective narrative, particularly a public confidence in the US dollar. I would suggest to you a couple things. One, US dollar strength is relative. That is, although we haven't done a great job of managing the US economy, most economies in the world have been managed so poorly that we look good in contrast. My friend Doug Casey describes the US dollar as the prettiest mare at the slaughterhouse, which is hardly an attractive proposition. Let me share an anecdote with you that you may have heard me say before, but I think is useful. Gold has done reasonably well over the last 40 years, but let me put gold in the context of US dollar purchasing power. When I was a young man, there was and still is a lodging chain in the US called Motel 6.
Mm, yeah.
Many people your age don't know that Motel 6 was named that because a room at Motel 6 was priced for years at $6 a night. I drove by a Motel 6 on my way to work today, and the price on the sign was Motel 6, $59.95, which is to say Motel 60. Now, there's only two explanations for this. The first could be that a room at Motel 6 is 10 times the size that it was 40 years ago, and the appointments are 10 times as nice. I don't know, silk sheets or something like that. The other explanation is that the medium used to purchase a room night at Motel 6, that is the US dollar, has fell by 90% in purchasing power in the last 40 years. I suspect, in fact, that the price of a Motel 6 is due to a decline in the purchasing power of the US dollar relative to a night at Motel 6. I haven't had occasion to do recent due diligence on a room at Motel 6, mercifully. Now, the important thing about this in terms of gold is that when a night at Motel 6 was cheap, at $6, an ounce of gold bought you 5 or 6 room nights. Now that an ounce of gold, now that a room at Motel 6 is expensive at $60, an ounce of gold will buy you 13 room nights. That says to me volumes about gold's value relative to the 4-decade-long depreciation in the purchasing strength of the US dollar.
Yeah, I think one thing interesting with gold over the past few years, before if anything was going on in the Middle East or oil, we would see gold start to spike up. But nowadays, gold seems to be somewhat disconnected to any type of geopolitical situation or turmoil. Why do you think that's so?
I think the global risk off asset is now the US 10-year Treasury. Anytime there's political instability around the world, investors around the world rush to US Treasury issuances. I, while I'm flattered by that as an American, I mean, it amuses me that the whole world sends us all kinds of cool stuff, cars, computers, everything. And we're able to send back the world pieces of paper with dreams written on them. I mean, I think this is a wonderful circumstance for me as an American, but I wonder how long the rest of the world intends to keep up this subsidy. My hope is for the rest of my life, but my suspicion is that this is too good to last. And if this becomes too good to last, and faith in the purchasing power of the US dollar begins to decline, then gold will do well. Let me give you one other statistic because we've been doing narratives and I like numbers more than narratives.
Okay.
In 1981, at the peak of gold's popularity in the US market, precious metals and precious metals related securities like gold stocks accounted for something like 8% of the total investment and savings matrix in the United States. The current number, that is the market share of gold among investable assets in the United States, is between 1/3 and 1/2 of 1%. So when gold was popular, it had an 8% market share. Now it has a 1/3 to 1/2 of 1% market share. If you look at the mean over 40 years, that number is closer to 1.5%. Gold doesn't need to win the war against the US dollar. It needs to lose the war less badly. A return of gold's market share in investable assets in the United States to the 4-decade mean, not to the high, would triple or quadruple demand for precious metals and precious metals related assets in a country that still controls 25% of the investable assets in the world.
Okay. You mentioned gold stocks. Can you share with us how you decide on allocating investment monies between physical gold, gold ETFs, and gold mining stocks? What would Rick Rule do?
I don't own any of the gold ETFs at present. Um, I'm a little uncomfortable with their capabilities to handle a liquidity squeeze a la 2008. I also personally own less physical gold than I used to in favor of the exchange traded gold trusts, which offer tax advantages to US citizens. Physical gold in the United States, like physical precious metals, is treated as a collectible, which means that any capital gains I might enjoy on it are subject to ordinary income tax rates, while the Sprott Physical Gold Trust continues to be taxed at the capital gains rate. In direct answer to your question, though, I think that the allocation between physical gold or physical gold equivalents, like our trust, and gold stocks depends on the nature of the investor. I consider gold itself and gold surrogates to be insurance and savings. I consider gold stocks to be investments, which are very, very different. And I allocate among gold stocks in the same fashion I might among other stocks, looking at them not so much as proxies for the gold price, but rather as fractional ownership of businesses that, yes, would do well in a rising gold price environment, but have to compete effectively against their peers. So in looking at gold stocks, I look more towards corporate efficiency than I do the gold price in terms of determining how, when, and how much to invest.
Okay, you've said before you only need one bull market to build life-changing wealth, and a new bull market may be knocking at the door. What did you observe that brought you to draw this conclusion or make this statement?
Well, personally, mercifully, it occurred to me. I built in the 1970s an awful lot of wealth for a young man, and then didn't pay good enough attention and destroyed it all. There were two lessons there.
But
The
you
most
had
important,
main
the
thing you
most
had
important.
fun destroying it, right?
Well, I didn't. I didn't spend it. I gave it all back. But I was ready for the second bull market. The truth is that a bear market in mining stocks characteristically involves a 50% decline in the price of your portfolio. Breathtaking. The one that we just went through, by the way, in the minor indexes, lost, I think it was 88% of its price. That's the bad news. The good news is that in subsequent advances, well-constructed portfolios of juniors can generate 500 or 1,000% increases. Uh, the truth is that the money that I invest today in less volatile asset classes all came from speculating on small cap natural resource assets in bull markets. The upside, well, let me say generally that the volatility and the cyclicality in this sector are probably unprecedented among all asset classes, which means that the declines are precipitous and the increases are dramatic. Now, think about the arithmetic we just talked about. Median decline is 50%, but a median advance can be 500%.
Mm.
So if you were going to apply this narrative in an arithmetic fashion, you would, if you were like most people, come into a market with, say, $100,000 at a top when the price action had justified the bullish narrative. And you would be rewarded for your prescient activity by losing half of the $100,000. So you'd come into the bear market with $50,000. If you were persistent and intelligent, you would reorganize this $50,000 portfolio to reflect new realities. And in the subsequent bear market, you would turn that $50,000 into $250,000 or $300,000. Now, the truth is that what you did is you turned $100,000 into $300,000, which is a good outcome. It's just that the part where you turned the 100 into 50 first that's unpleasant. If you repeat that cycle, as I did over 40 years, the end result is that you've made truly a staggering amount of money relative to what you started with, but you've endured plenty of periods of psychological pain in the middle.
Yeah, well, it seems like you came through that pain okay. I mean, you always smiling, happy. You got the cool World War I helmets up there. I mean, that looks pretty good to me. But besides gold, what other resources are currently on your radar?
The stuff that everybody hates. I like uranium. Uranium on a global basis is selling well below production cost.
Hmm.
I don't see it increasing in price in the next 12 to 18 months, but uranium bull markets are the most aggressive of all bull markets, if past is prologue. So I like the uranium business. I like the agricultural minerals business for the same reason. Potash, phosphate, uh, these are necessary for the continued existence of mankind. And on a global basis, they're being produced for less than production cost. I'm optimistic about the copper price, although a global economic slowdown could make that somewhat more problematic. I'm optimistic about nickel because everybody hates it. I'm optimistic about zinc because everybody hates it. So you get my theme. Uh, you can't forecast the when appropriately. But if you find a commodity where there will be broad demand for the commodity 7 years from now or 10 years from now, and it's being produced, that is, the cost to produce it is higher than the selling price that the industry receives for it, that means that the industry itself is in liquidation. And there are only two possible outcomes. One, society won't have an element that it needs to survive, or the price will go up. It's really pretty simple. uh, as I age a little bit, ironically, with less time on Earth, I become more patient. And I'm willing to give up time certainty for answer certainty, meaning that I prefer questions where the answer necessarily begins with when rather than if. So anytime I can find a commodity where a price increase over time is a certainty, I gravitate towards that commodity.
You mentioned nickel. What do you think of battery metals such as nickel and cobalt with the electric vehicle story gaining some momentum?
Well, I think it's a wonderful story, and I don't think it's purely a story. But I think the other uses of those metals are currently much more dramatic in terms of their pricing impact. I would point out to you that the real rage has been lithium, which I don't think is in short supply. I think productive capacity, that is, our ability to process the lithium that exists in the world, has been short relative to the increase in demand. But I would point out to your listeners that by weight, the lithium battery is really a copper nickel battery. And I like both copper and nickel as themes around electrification worldwide in general, not merely the sort of battery market. Cobalt is a unique mineral in my experience. There may be others, but it's the first material that I know of where users worldwide have said that they would be willing to pay increased prices to get better supply certainty, sort of a build it and they will come circumstance. There's a suggestion among users that cobalt has such amazing properties that if the supply would triple, the price could double because they would employ it in more fabrication technologies. The problem with cobalt is that it seems to occur mostly in places like Congo and Russia that give investors pause as a consequence of political uncertainty. Everybody wants politically correct cobalt. That is, cobalt coming from places like Canada and Australia, places that don't have much cobalt. We have to recognize that what we want, if we can't have it, is irrelevant. If you're going to be in the cobalt space, you have to have the courage to own stocks like Glencore and Norilsk, people that actually have cobalt.
It's been 10 years since the last financial crisis. How will resource stocks be affected in the next crisis?
If the next crisis is liquidity driven, remember that resource stocks are stocks. In a market where stocks go down as a consequence of liquidity crises, all stocks go down. The decision to sell isn't often made by the investor, it's made by the margin clerk. And the margin clerk will sell whatever has a bid, irrespective of the basic business of the issuer. Where commodity stocks might do well is that they might come back faster. But in a circumstance like 2008 or the 1987 crash before it, you need to understand that bear markets that are liquidity driven, take no prisoners in the near term.
Okay. I don't know if that's good or bad, but Rick,
is.
Rick, before we wrap up, could you let our listeners know more about Sprott Global?
Sprott Global is part of the Sprott Group, publicly traded in Canada on the Toronto Stock Exchange, symbol SII. Sprott Inc. is a money manager and investor focused in natural resources and precious metals worldwide. Sprott Global is the U.S. Investing arm of Sprott Inc. And we provide advisory and transactional services to investors, corporations, and institutions worldwide focused on natural resources and precious metals. We love the opportunity to talk to individual investors worldwide, and we would invite you to visit our website, www.sprottglobal.com. As a special inducement to your listeners, anyone who emails me personally at my own email address, rrule@sprottglobal.com. That's RRULE at sprottglobal.com. If you will, in the text of the email, not as an attachment, include the name and symbol of resource stocks in your portfolio, I will, on a no obligation basis, rank those resource stocks. Wow. and return the email to you. Note that this doesn't constitute investment advice. I'm just ranking the resource stocks in people's portfolios. Note also that I won't be able to rank non-resource stocks because I'm too busy following the stocks that I understand.
Okay, wow, Rick, that's a pretty generous offer. We appreciate that, and I'm sure you're going to get quite a few of emails. But I know you're quite busy, and is there anything else you'd like to include?
No, I think you've done a fairly good job, and I want to thank you for prefacing the interview with the fact that you've looked at some of our work before. I appreciate the intelligent questions.
Hey, thank you, Rick. We really appreciate you coming on, and I'm sure our viewers will appreciate it as well. But I'm hopeful we can do this again, and I look forward to more of your writings and your little your Rickisms, as I call them. I think those are pretty cool. But we hope to see you again, and we wish you a good day and all the best.
Flattery will get you everywhere. Thank you.
Cool. What are those helmets behind you?
World War I helmets collected by my great-grandfather.
Oh, sweet. That was Rick Rule, President and CEO of Sprott USA Holdings. To find out more about Sprott Global, please visit their website, sprottusa.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.